They look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, the highest in U.S. history. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table, 130%? The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. Everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, the highest in U.S. history. Tons of research at those debt to GDP ratios. You can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. economic growth is incredibly weak. So we've got sky high debt to GDP ratio. Economic growth is weak. We're in a recession. We've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries. The fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP and they come in at different times with different lags and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But they say, okay, here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number. But they don't guess at the stuff they don't have. And it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 0.2 or 0.3, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP sky high, economy weak at best, probably had a recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. Yeah. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% 90% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, I forgot the deficit. The baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act,
Right.
and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion. Two for Trump, that's six on top of two baseline. That's $8 trillion in 2 years. So your deficit's out of control and your trade deficit's out of control. So what's not to like? For this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. So I'm like a 27 or whatever, a 28 maybe year old lawyer, but I'm probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Riston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. It's basically about the collapse of confidence in the US dollar. The stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates or the price of gold. But he said the money it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. But the one thing but it presupposes that you can always borrow in the Eurodollar market, provided the big banks are willing to lend to each other. So if my example, if UPS was selling the gold to the Arabs and they got the money and they put it back in Citibank Nassau, it's all good. That money supply, now I'm talking about Eurodollars, actually shrank. And that is a heart attack in the global financial system. So now we're like, well, okay, what's going on? And believe it or not, there's a global dollar shortage. And when you say that, people say, wait a second, you kidding me? The Fed printed, the Fed's balance sheet in 2008 at the start of the global financial crisis was $800 billion. It was $4.5 trillion by the time we got to the end of the taper in November 2014. Then, okay, Yellen a little bit, but mostly Powell got it. They started quantitative tightening. They got it back down to around